All right, there's a lot happening with the economy right now, and it's pretty tough to keep track of everything, even if you've spent your whole life studying this stuff. So here's a quick explanation of what's going on that hopefully is a little bit easier to digest. And I want you to imagine the economy as a block party. And in this neighborhood, there's really four key types of houses. There's consumers who are spending money at the party. There's businesses who are selling goods and services at the party. There's the government who's setting the rules for the party. And then there's the Federal Reserve. And their whole job is to oversee the vibes of the party, making sure nobody gets too crazy and that nobody calls the cops. Now the street, this is the market. And this is where businesses can have booths where individuals will walk up and either buy the goods and services from them or have the opportunity to invest in the company if they want to share in its success. Now this party's been going on for a few years, and for the most part, everyone's been enjoying themselves. But over time, we've seen that prices have started to rise, and that's inflation. And eventually, even the basics started to get, well, out of touch.
I mean, it's one banana, Michael. What could it cost? $10?
Yeah, exactly that. But here's the crazy part. Even with prices spiking and some people spending less on the goods and services provided by these companies, there were still a lot of people who wanted to invest in these companies because they saw a lot of potential and didn't want to miss out. That made things even harder to read. Prices were up, spending was down, investor excitement was through the roof. Vibes were starting to get a little off. So the Fed came in and said, all right, we need to reassess things here. So to cool things down, they raised interest rates, making it more expensive to borrow money to run your booth or build a house, essentially slowing down the party overall. With less money flying around, booths couldn't keep charging those high prices. If no one's willing to pay them, you gotta bring them down. That's how raising rates cools inflation. But it's not all about spending. When rates go up, it also changes where people want to invest. Suddenly, this other party down the street, the bond market, looks a lot more appealing. It's calmer, more predictable, and now it's spitting out some healthy returns. So some investors leave for the bond market, others leave entirely and are just like, I'm done partying, I'm sick of this, I need to go home. But this is why it's been such a roller coaster lately, because everyone's trying to figure out where to go next. And then just as the Fed's cooling things down, boom, tariffs. For a while, most booths were getting their ingredients from outside the neighborhood. It was cheaper and easier. But the government stepped in, said, we want you to buy local, and slapped extra fees on imports. And that made things more expensive again, just as the Fed was bringing prices down. So now we've got rising costs and slowing demand. So yeah, the party's still going, but with high prices, expensive borrowing, investors jumping from one party to the other, and rising costs, it's definitely been a wild ride. And in times like these, the most important thing to do is stick to your plan. Markets will swing, news will change, but if you stay grounded in your investment principles and focus on your long-term goals, you'll stay on track to reach them. Want more help navigating turbulent markets? Follow along for more insights.